Hello! Today I'm going to be showing you how to do some basic general journal entries. Before we do the problem, I want to give you a brief review of aid liquor. So aid liquor is just a way for you to remember which accounts increase with a debit, that's the ADE, and which accounts increase with a credit, that's the LCR. So first, the accounts that increase with a debit, that's A for assets, D for dividends, and E for expenses. Then we have the accounts that increase with a credit, that's L for liabilities, C for common stock, and R for revenues. Now, just as these accounts increase with a debit, they're going to decrease with, well, the opposite, a credit. And these accounts that increase with a credit are also going to decrease with a debit. So you can kind of switch it around for whatever you need in your journal entry. And you'll see how this works as we get into the actual journal entries here in just a minute. Alright, so the problem says, on July 1st, 2010, Elmer Fudd started Wascally Wabbit Pest Control. The company provides pest removal services. The company entered into the following transactions during the first month of operations. So we've got on July 1st, we can put our date in the date column. E. Fudd invested $10,000 cash and equipment valued at $20,000 in the company in exchange for common stock. So what I'm going to do here is I'm going to highlight in red the important words, I suppose, in the problem. So July 1st we have he invested cash, so I'm going to put that in red text. And he also invested equipment, so that's going to be important. And that was in the company in exchange for common stock. So I'm also going to highlight that one. So first let's focus on the cash. From the perspective of the company, they are gaining cash. They're getting 10,000 cash from this guy, E. Fudd. So cash, if we remember, is an asset. It's something that we own or control. So if we are getting cash from the perspective of the company, that means cash is increasing. So we have an asset that is increasing. So that means it's going to be a debit to cash. So we can put that in our journal entry here, cash, and for the debit column, that's going to be $10,000. Now, equipment's going to follow similar reasoning. The company is gaining $20,000 of equipment. So that means their equipment is increasing. So therefore, it's going to be an asset because equipment is also something you own or control. So we're going to have a debit to equipment for $20,000. And then we finally can move on to common stock. Common stock is going to take on the value that is the total of the cash and equipment combined. And this is also increasing, and common stock falls into the category of increase with a credit. So we can put common stock over here as a credit for $30,000. Alright, now there's a couple of things I want to note about this journal entry. First is you must always list your debits before your credits. So you notice I have cash and equipment listed first, and those are my two debits. Then I list my common stock, which is my credit, and that's last, after the debits. You always have to have that whenever you do a journal entry. The other thing is, make sure your debit total always is the same as your credit total. So we can check that here. 20,000 plus 10,000 is the same as 30,000, so we have that. And one more thing, some teachers might want you to write a small description of the transaction right below it. So for example, we might say a investment of cash and equipment for common stock, something like that. So if your teacher wants you to put a little note underneath it, then make sure you do that. If your teacher doesn't want you to do that, then don't worry about it. In this video, I'm not going to worry about the descriptions. Alright, moving on to the next transaction. This one's also on July 1st. So I'm going to skip a line here just so it's a little bit neat. And we have the company paid $100 for this month's telephone bill. So the important parts are that we paid cash, and that's for a telephone bill. This is one of the costs to run the business, so we're going to consider this an expense. And since we're incurring this telephone bill, this is going to be an increase in an expense. So therefore, that's going to be a debit. So we can put telephone expense as our debit, and that's for $100. Secondly, we have a payment of cash. And we'll remember cash is an asset, but if we're paying cash, that's not an increase of cash, that's actually a decrease in cash. So we're going to have to do the opposite. So it's not going to be a debit to cash, it's going to be a credit to cash. So we'll put cash in here, and that's for $100. All right, moving on to July 2nd. The company purchased additional equipment, and that is on credit for $3,000. So similar to July 1st, we have some new equipment that we've added to our books. This is an increase in equipment because we have more than we did previously. So we remember that equipment is an asset and it's going to increase with a debit. So we can put equipment here, and that's for $3,000. And this time we didn't purchase it with cash, we purchased it on credit, meaning we're going to pay for it at some future date. And if we're going to pay for this at a future date, we consider this a liability. Specifically, it's going to be accounts payable. And accounts payable is going to increase with a credit. Now the reason it's increasing is because we owe more money than we did before this transaction. Therefore, that's an increase in liabilities. So we can put accounts payable, and that is for $3,000. All right, next one is July 4. The company performed $300 of services for cash. So that's going to be services and cash. Those are going to be the two important words here. So let's first look at the cash. We performed $300 of services for cash, so that means we have gained cash. Cash is increased, and cash is an asset, as we'll remember, so that's going to be a debit to cash. So we can put that in our journal entry for $300. Now the services is one part that we haven't seen quite yet. So this is money that we have earned as doing our services, whatever we provide here. I guess this is pest control services. And therefore this is going to be a revenue. So our revenues have increased because we have performed this service. And revenues, as we see down here, is going to increase with a credit. So we can put pest control revenue, and that's going to be for $300. All right, moving on to July 5th. On July 5th, the company performed $800 of services, and this time it's on account. So this is very similar to the previous transaction, except for we're not collecting cash. We are going to collect on account, meaning this person or company that we provided the pest control services for is going to pay us at some later date. So we consider this accounts receivable. And if we remember, accounts receivable is falling under the window of an asset, something that we own or control, or we're going to receive the future benefit of cash from. So when we have an increase in accounts receivable, because the amount that other people owe us is increasing, that's going to be an increase in assets. So that's going to have to be a debit. So we'll debit accounts receivable, and that is for $800. And just like last time, we performed services, so we're still going to have pest control revenue, and that's going to be for $800 as well. Once again, remembering that revenues increase with a credit. Okay, so on July 6th, we've got the company collected $800 for the services provided on July 5th. So this is a little bit tricky when you have a transaction that refers back to a previous transaction. The important part is actually going to be this date, because we're going to have to look back at July 5th here in just a minute. And the other part is going to be that we collected the $800. Now the reason why the services are not important this time is because these are services that were performed previously, one day before, right? So therefore we don't need to record anything related to service revenue again, because that was for services on a previous date that were already recorded. So let's first focus on the collection. If we collected $800, we should be getting familiar with this now. That's going to be cash again, increasing with a debit. So that's going to be cash for $800. And if we look back to July 5th, because that's our other important part here, we'll notice that we had accounts receivable for $800. Well, now what's happening is we are collecting that accounts receivable. So accounts receivable is going to be decreasing. We're collecting it. So that's going to be the accounts receivable. We already know that's an asset. And if it's decreasing, we're going to have to credit accounts receivable. So we'll put accounts receivable for $800. And this is a little bit easy to see. If you match these two up, you'll see, okay, as of July 5th, $800 was owed to us. And as of July 6th, it's been paid out to us. So we are kind of closing out our accounts receivable right here. You'll notice the 800s cancel each other out, leaving that accounts receivable back at zero balance. All right, moving on to July 8th. On July 8th, the company paid $3,000 cash, so paid is important, for the equipment that was purchased on July 2nd. So again, that date's going to be important. So let's first look back to July 2nd. July 2nd was the purchase of equipment on credit for $3,000, and that's right here. We had accounts payable for $3,000, but now since we're paying off the accounts payable, we want to get that off of our books. And if we remember, accounts payable is going to be a liability, which increases with a credit, and therefore if we want to decrease it, get it off of our books since we're paying it off, that's going to have to be a debit to accounts payable. So we'll put accounts payable here for $3,000. And one mistake some people might make is they might want to confuse equipment into this transaction, but we don't actually need equipment because the amount of equipment did not increase or decrease, right? We didn't actually get any new equipment or sell any equipment, we're just paying it off. So therefore we don't need the equipment account, we actually need the cash account because we're paying that off. So this is a decrease to cash. Cash is an asset, so a decrease is going to be the opposite of a debit, which is going to be a credit to cash. Alright, so down to July 17. On July 17, we paid $175 in employee wages. So again, the payment is always going to be important if that's in there, and that's for employee wages. So let's first focus on the wages. Kind of similar to the telephone bill earlier, this is the cost of doing our business or running our business. So this is going to be another expense. And we know that expenses increase with a debit. We've incurred an expense, which is an increase in expenses. So we're going to have to debit this, and usually we call this wages expense. And that is for $175. And whenever you have paid in there, you know that's going to be cash. So we're going to have cash for $175 as well. And remembering that this is an asset which decreases with a credit. Since we're paying it out, it's going to be a decrease in cash. Alright, we're on to the last journal entry, which is July 31st. And on July 31st, we have a payment of $200 in dividends. So payment's always going to be important, and this time it's for dividends. So if we look down here, we see dividends are increasing with a debit. And this one may be a little bit more difficult to think about whether or not it's increasing or decreasing. This is actually increasing the dividends, meaning increasing the amount of dividends in total that we've paid out. So this is going to be a debit to dividends. And that's for $200. And the credit's going to have to be, well, again, we are paying out something, so that's going to have to be cash again. So we can put cash in here, and that's for $200 as well. Alright, now we finish all of our general journal entries. So if you think this went a little bit too fast for you or you got confused along the way, maybe try rewatching this video and pausing after each transaction to make sure you understand what's going on. One little tip for you is to just pay attention to whether or not cash is used in the transaction. Again, that usually comes for any time that the word paid is used or sometimes the word cash is used. A lot of times students are not realizing that cash is actually going to be used in one of these transactions. You'll notice it's in almost every transaction, so that could be maybe a good way to get you started on completing some of these general journal entries.